So I'd like to make a very warm welcome to everybody who's logged in for this call. It's a real honor today to host you to this Zoom webinar. And before we get started, I'd like, on behalf of the business school, to acknowledge the people of the Kulin and Wurundjeri nations on whose land many of us are gathered today. And I'd like to pay my respects to their elders past and present. Just by way of background for the audience, some of you are still joining. I'll raise this point again. You can post questions using the Q&A feature available at the bottom of your screen all the way through the presentation. We've set some time aside at the end for John to answer the questions. John Vaz, a colleague of ours in the business school, he works in the banking and finance department. John worked for many years as a senior executive in tech companies, usually in the finance function, working for companies like Tesla and Ericsson. He's worked obviously across Australia, but also in Southeast Asia and the UK. John's greatest interests have been in the macroeconomy and how it impacts the financial markets and the institutions, and most importantly, investor behavior. His recent papers on cryptocurrency with Kim Brown, who's also on the call, has looked at the sustainable development of cryptocurrencies. And my sense is that it stems from his earlier work, a great deal of work, his interest in currency trading. So once again, we look forward to your questions. Please post them in the Q&A section on Zoom, and we will return to these at the end of John's session. And please also ask questions which haven't been covered in the presentation, because for us, those questions are important. They inform our own interests and the types of research that we do in the future. So once again, thank you very much for joining us. And over to you, John.
Thank you, Edward. This morning, I should say this afternoon, depending on where you're sitting, we're going to cover a bunch of topics, but principally we're going to look at how cryptocurrencies have changed over recent times, and particularly look at how cryptocurrencies offer opportunities going forward, given the COVID-19 crisis that's been put upon us. And as well as that, look at how the economy will respond and change in a post-COVID environment to understand how cryptocurrency fits in that world. And there are a number of opportunities that I can see for cryptocurrency in a post-COVID world, which I'll talk about. So we'll go through but first start off and look at what exactly we mean by money. I'll give you a quick snapshot of what cryptocurrency is, a bit of a primer. And then I'll focus on some of the new developments in the cryptocurrency area. When I say new developments, it's not necessarily technology, although it's more about how it's being deployed in the marketplace. We'll then have a look at COVID-19 in a bit of detail, because COVID-19 provides some significant changes that'll be evident to you as we go through in our economy now and over the next few years. We hear the term COVID normal being used, for example. Well, what does that mean? I don't know, and I'm sure a lot of you don't know yet, because we're right in the middle of it. But certainly there are significant economic impacts on our economy already being felt, and we'll talk about that. And then I'll go into specifics about the scenarios in a post-COVID world. By the way, some of that scenario also is caused by geopolitical changes that are occurring alongside the COVID pandemic. And you've all heard of some of the more recent trade frictions and currency controls and so on, which I'll talk about, and how they raise opportunity for cryptocurrency. But anyway, let's start off by talking about what do we mean by money in the first instance. So when you talk about money, money is a social construct. In other words, money is created within societies. Excuse me. Money is created within societies based on the needs of those societies to trade. So depending on the domain that money is used, by domain I mean where and who is using that money, the physical circumstances, we can have different manifestations of money. For example, historically, we have seen things such as cowrie shells gathered from beaches being used as a form of money. And in time, we've seen gold coins or metal coins, copper coins, and eventually we've seen digital money emerge. So money can manifest itself in different ways depending on the needs of society and the culture and the environment. By that I mean the political environment. For example, as governments have emerged, they have had need to tax, and as society got more organized, they've issued money. And we'll talk about the fact that a bit later you'll see that money isn't necessarily always issued by government. Money, in fact, has historically been issued by private parties. I'll talk more about that later. So the summary of this is that money is a social construct that allows us to have credit. Without money, the concept of credit could not work very effectively. It facilitates taxes, and importantly, as the lawyers will tell you, it allows payment, finality of payment to occur. And if you picked up an economics textbook, it'll probably be talked about in terms of the functions of money, namely the medium of exchange, a store of value, or unit of account. So the question is, what can be money? Well, anything can be money, as if we decide it's money. So when we talk about money, we need to understand what sort of attributes money should have. Now, I'm telling you some of this background because it'll be apparent to you why cryptocurrency can be viewed as money based on the attributes it holds. And we talk about money in our paper, Kim and I, about money having intrinsic attributes and extrinsic attributes. By intrinsic attributes, we mean the things that are embedded features of that money. So if I decide to use gold coins as money, then it has specific attributes that allow it to function as money by virtue of being gold. It has other characteristics, of course. Gold has more than one use. It can be used as money, or it can be used to make jewelry or in other things and so on. So there's certain intrinsic or embedded features that something we choose to use as money holds. But we can also talk about money having some extrinsic characteristics, meaning things we add to it, things that we bolt on, if you like, to make it more acceptable in society as money. And one of those things is, for example, social acceptance. We won't trust cowrie shells or any form of money unless it's widely accepted in society as a form of money. Now, sometimes that means we want institutions to help us legitimize it so we can trust it. But as well as that, a whole bunch of other things we add to that money to make it more usable. So we might have governments who then say, well, this money is legal tender and can be used for settlement of any debt or transaction in a particular state or country. As well as that, we implement things such as transfer protocols, the way in which money is exchanged and used. A transfer protocol would be how we can exchange money and pass it between us, be it electronically or physically. On checks, for example, checks would be a form of a transfer protocol. And of course, money can be disintermediated. We always assume that money needs banks. There's no need for a bank if you have the money and can transact directly, peer-to-peer. I can go to a marketplace and I do a deal with someone to buy whatever I like in a marketplace and hand over the money. So it can be disintermediated depending on the circumstances. So it's important to understand these attributes, as you'll see, when we're talking about new forms of money like cryptocurrency. So this slide summarizes what I've just been talking about. Excuse me, I should have, I got it out of kilter. But anyhow, so intrinsic and extrinsic attributes I've just explained are the attributes that money holds versus the attributes that we add to money. But moving right along. So we've talked about money as if it were all typically created by government or some private individual. But if you look at money today, and in particular, if you look at money in the United States, just an example, you'll see here, and this chart is a bit noisy, but I'll just focus on this bottom part here. You will see that only about 15% of money is in fact created by government. In other words, the printing we hear people talking about, you know, how much money is printed by government and so on. A very small proportion of the overall money available in society is created by government. In fact, excuse me, this is, in fact, what we see is that, and we classify money in terms of M0 and M1 and M2. I won't bore you with those details, but the actual money in circulation and dollars, if you like, created by government is only about 15% of the total money. In fact, most of the money created is in fact created by banks, financial intermediaries, and around 80 to 85% of money in our society is created by banks. When you go to a bank for a loan, the bank creates that money by deposit, saying you have this in your account. So it uses a form of money we call account money to create the money that you can then use. And in a fractional reserve system, banks have the ability to create this money, unlike, as we will see, under cryptocurrency, where banks do not have the ability to create money. They cannot create money they didn't have in the first place. And it's one of the motivations for cryptocurrency is to control how much money is created. And we'll talk about that in a bit more detail later. But the main takeaway from this particular slide is that most money is created by banks and the financial institutions as they transact in the marketplace. So let's now talk about the different types of money in terms of how they're classified in a digital world. So in a digital world, we can talk about two types of money. On the top part of the screen, we can talk about account money. So account money is money in your bank account. Typically, you have money sitting in your bank account, as do I, and basically the banks keep a record of the money you have, and when you pay someone, they transfer that money between the banks, your bank and mine, and a form of settlement occurs to say that I've paid you. Now, this is important because under this structure, it is only banks who are able to complete those exchanges electronically, whereas in the cryptocurrency world, they provide the ability to transact directly without having intermediaries. And this slide really goes to set out how that process occurs. So essentially, once we decide to transact, we instruct our banks, be it electronically or otherwise, and the transfer between our accounts occurs. Now, those accounts are verified by commercial banks. If you're with the ANZ and I'm with the Commonwealth Bank, each bank verifies that we both received the other end of the transaction. That's called settlement. So banks facilitate settlement of transactions between two parties. If we look at the bottom half of the screen, we can see a slightly different model here, and this is a token model. This is where the money exists as a digital artifact. In other words, it's a creation sitting on a computer as a representation of something in the real world. And in a token model, it's possible to transfer money as a token, and think of a token as something representing something in the real world. And I'll talk more about that a bit later. But all I need in a token model is a digital wallet, and those wallets are held by us. And when I want to transfer money from one person to another, party A to party B, it's a matter of my simply taking the money out of my wallet and putting it into yours. But obviously there's a bunch of technology that sits behind that. So token model doesn't need banks. It relies on electronic platforms to facilitate those transactions, which is the basis of cryptocurrency. So I'm going to do now a short poll just to see your experience with cryptocurrency so far. So Deborah will activate the poll, and this will allow you to, it'll take a few seconds to do, just to get an idea of how many of you have had exposure to cryptocurrency. Now, whilst this poll is going, a couple of observations. If I had done this 12 months ago, or maybe even 2 years ago, I would not have seen any responses on the bottom one. I would have seen mostly in the middle, the three responses in the middle. Anyhow, we'll pause there and move on and continue. Okay, so what is cryptocurrency? So cryptocurrency is more than money. It's a digital representation of money Yes, it can be an asset as well. It can be any kind of asset, in fact, provided it can be represented digitally, but it can be exchanged. It's typically private money. In other words, it hasn't been created by governments. It's operated in what we call a distributed ledger. Now, a distributed ledger, very simply put, is records of transactions held on many computers around the world, but it doesn't necessarily involve banks or formal institutions. You and I could be an operator of a distributed ledger, for example, in Bitcoin. If we had a computer powerful enough, we could operate as what they call a miner on Bitcoin. Cryptocurrencies are encrypted. They are accessed via digital keys, and importantly, they can be anonymous. Now, I say can be because depending on the cryptocurrency, some of them are very, very secure and certainly secretive, you could say. Every transaction is encoded to the extent that you can't identify who's sending the money to who. Ones like Cardano and so on, and Zcash, and there's many others that are used for transfers that are completely anonymous, versus Bitcoin, where you can identify not who it is, but you can identify an instance of a wallet. So you might know wallet number 5 and wallet number 7, but you don't know who owns them. And we call that pseudo-anonymity. Now, it also has borderless payments. So cryptocurrencies are money of sorts, but they also have a payment system put together. If you think about regular money, we have dollars and so on. The payment system is completely separate from that. There's a bank, there's maybe use EFT or something like that to transfer the money. But in cryptocurrency, the two things are combined. The payment system, and importantly, they operate borderless across any country, across any boundary. And finally, and most importantly, cryptocurrencies are typically programmable because of their construct. They have, some of them have different scripts and programming languages, but they're all programmable. And typically, particularly with Bitcoin, they are decentralized. In other words, there's no central governing authority that issues the money. It's issued using software, which is run on a consensus basis. Everyone runs the same software, and everyone checks on everyone else using their computers. Let's do some crypto speak now. So crypto, we use the term tokens. So tokens are a claim or reference to something. Now, I mentioned the word tokens because what happens is that with tokens, we are using it to represent an attachment to something in the real world or a representation of something. Now, think of a token as when you've gone to a theater and you've handed in your coat and the person hands you a token or a ticket. That represents your claim against your coat when you return. Well, that's what a token is in the digital world as well. It's a claim that you own something and control something. Blockchain is the platform on which cryptocurrencies are built. And the technology, and not enough time to go into that here today, but the technology is based on the idea of creating an immutable time sequence set of transactions that maintained by a bunch of people on a consensus basis. We've introduced the idea of wallets already and coins, but coins and tokens are sometimes confused. Coins are typically attached to the platform representing specific payment objects, objects that represent transfer of value or money. Whereas a token can include money, but represent other assets. And finally, a new term that's come up over the last few years is the term stable coins. A stable coin, and stable coins emerge very rapidly in the cryptocurrency world because of the highly volatile or changing prices we see with things like Bitcoin. And of course, if you've got something that changes in value, it makes it very difficult to transact and do business because you don't know what it's going to be worth tomorrow. So you may be a winner or a loser depending on how the value changes. So what do we mean by tokenizing something? Very briefly, so tokenizing means mapping an asset to a digital representation, as I mentioned, or claim of ownership. But importantly, it's unique and immutable in the cryptocurrency world. It's a bearer instrument. This is a really important point. The person who holds the digital key is the bearer. It doesn't care who has it. It only cares that you have the digital key. And this is a source of concern for some people, that if there's a loss of that key, well, what happens to my money? Well, until recently, depending on which cryptocurrency and how you access it, if you lost your digital key, your money was gone, it was lost. It's as simple as that. And finally, of course, tokenization means it's easily verifiable. By looking at the token using your computer, you can verify it's real or not, and that it's unique. So you can't use it twice. You can't counterfeit. And as I mentioned before, it's programmable. Now, programmable means that transfers can take place algorithmically, meaning computers can do that themselves without necessarily human involvement once we encode the rules. So let's have a look at this idea of algorithmic capability by way of what's called smart contracts. Now, smart contracts aren't new to cryptocurrency. They were proposed by a very smart guy called Nick Szabo in 1994 in a famous paper, where he suggested that smart contracts are a way of computers executing obligations without human intervention. So if we write a contract and we can encode it in a system, then it can be executed by computers and people wouldn't be cheated. The contract would be honored. So in this model here, what I'm trying to show you is that on the right-hand side of your screen, you can see that we have Bob and Alice here in the real world who decide to enter an obligation of some sort and some payment terms and qualify that in a contract. That contract can be recorded on the blockchain as a smart contract. The smart contract, when some kind of event occurs, will execute, and I've got a thing here called an oracle. An oracle is simply a validation of the existence or the trigger of a particular event. So that oracle basically says, this happened, something happened based on the contract. The smart contract then says, okay, I've got the data I need. I will then enable a payment mechanism to transfer the money between Bob and Alice. So this is what one of the main innovations that are possible on blockchain and cryptocurrency. And by the way, probably the most popular cryptocurrency for doing smart contracts is Ethereum, not Bitcoin, but Ethereum. Ethereum, in fact, in terms of transactions, is way larger than Bitcoin and much more functional than anything Bitcoin can provide. Although Bitcoin has the most value, the most usage is in fact within a thing called Ethereum. And there's a new version coming out, for example, Ethereum 2 in the next few months or so. But it's this smart contract ability that really makes cryptocurrency shine above all others. And if you think about it, if you enter into a contract, you supply something, you want to be able to settle. In other words, you've exchanged your goods and get paid. You want it to be able to settle without any delay or without someone intervening or trying to cheat you. Well, smart contracts make that possible. And already we've seen early versions of this in the marketplace. In the case of Ethereum, the most popular smart contract is called an ERC20 token, which is used for capital raising. It's used for issuing equity. It's used for all kinds of things. In fact, creating other cryptocurrencies. So moving on. So what are the promises of cryptocurrencies? And they make many. They make lots of promises. They say that, well, you don't need banks. You can transact without intermediaries. Well, let's see. There's been some problems with that idea, although it's still possible, but people don't trust cryptocurrency, and intermediaries have emerged as an issue in terms of how to trust cryptocurrencies. Greater social justice and access to finance. Cryptocurrencies can be accessed by anyone with a computer or a smartphone. You can get a cryptocurrency account in theory. So there's a promise that all the unbanked in the third world, in Africa, in India, and so on, can access cryptocurrency, get a wallet without having to pay bank fees and all this and all that sort of thing. Greater security, integrity, and privacy. Yes, anonymous, it's secured cryptographically, and so on. So it makes it more secure. Now, some argue that they're not that secure because, you know, it's in the public eye and so on. But in fact, the construct of a blockchain is such that if it's publicly operated, it's actually more secure than a bank running its own computer system. You may be surprised to know that Bitcoin although you hear a lot about it, Bitcoin has never been hacked. The exchanges where people have transacted with Bitcoin have been, but if you like, the banks that sit on top of Bitcoin, but Bitcoin itself has never been hacked. Faster, more effective transactions. This is disputed by many because it's not at the scale that most existing fiat systems, you know, Visa and credit cards and so on, but certainly they claim they can be faster. And there are some cryptocurrencies that are in fact as fast or faster than existing payment mechanisms. Greater fairness and debasement protection. Fair because cryptocurrencies are finite and no government can create a lot of money, cause inflation, devaluing your wealth. So you think about it, you've got money sitting in your bank account, and if you happen to be living in somewhere like Zimbabwe and the government prints a lot of money, your bank account next day is worth nothing compared to what it was the day before because of hyperinflation. So debasement protection, more efficient and lower cost, the internet, etc., and that sort of buzz hype around being cheaper, etc. But this is yet to be established and proven. Borderless and frictionless. Certainly, this is one of the attractions and the early attractions of Bitcoin, was that it was borderless and able to be transferred across country without government intervention. And of course, finally, they came to be more innovative and provide greater functionality, and they do. But yet to be seen as to whether it'll be adopted more widely. So let's talk about some developments in cryptocurrency. And there's another poll I'd like to post, but I'll just share the previous results. And then we'll move on to the next poll. So let's have a look. So in recent times, and I say recent times, in the last 3 years, you could say, since 2017, because of the volatility of cryptocurrency, particularly Bitcoin, there's been a lot of questions about whether they are in fact a store of value and a unit of count. Can you use them to measure value? And there are a lot of trust issues with cryptocurrency because of all the scams that have occurred. And there's been a rapid growth of stable coins. Stable coins are simply coins that don't fluctuate in value, and they have some method to manage their fluctuation. For example, they might be collateralized, in other words, backed by fiat, backed by US dollars or some other currency, or some other asset portfolio that they're linked to. They may have a reference basket. In other words, they measured against a bunch of other assets so that if those assets fluctuate in value, this currency is changed to reflect some constancy, so the value doesn't change. They're reserve backed. In other words, they have some kind of reserve by the issuing organization. Now, this only applies to some cryptocurrencies where they have a central issuing organization of some sort, typically a federated type situation. And finally, algorithmic. They vary the supply based on the value of the coin in the marketplace. So if they become very popular and the price peaks because there's more demand, they'll print more. Or if the demand falls, they'll withdraw them and buy them back. So they vary this, and they use a number of different techniques. But the point is they all have some mechanism for stabilizing the price. Now, probably the most famous one that's likely to emerge, in my view, is Libra. Libra is the cryptocurrency proposal and platform proposal that has been initiated by Facebook, the Facebook group. And Facebook, as most of you know, dominates the world of users around Instagram, WhatsApp, Facebook itself, and Messenger. It has billions of users. Now, what Facebook and I should say the Libra consortium have proposed is the creation of a consortium who will do a bunch of things. The consortium over on the right-hand side, Libra, will manage some kind of federated blockchain, which means there'll be other participants who run the blockchain. Remember, I mentioned before, it's a distributed ledger shared by many and operated by many. But in the case of Facebook, you have to make some commitment to join this association, pay money and so on, and operate the blockchain with them. They will operate payments and smart contracts, digital identification using what we call, excuse me. I've got a very touchy mouse here, pardon me. So basically what will happen is they'll have digital identification and what's called unhosted wallets. Now, The difference between Facebook and other cryptocurrencies is Facebook will use partners who will offer digital wallets that can be hosted. In other words, you can get your wallet from an intermediary like a financial institution or like a bank account you do today. You go to a bank, the bank issues an account. If you lose your code, the bank can recover your account. So Facebook is taking some aspects of the existing banking system model and applying that. They will also be compliant with a whole bunch of regulatory issues like anti-money laundering, counter-terrorism finance, know your customer type regulations. They will be compliant to that, they say. And finally, and most importantly, they'll operate what's called a Libra reserve, which is a stable coin. And in fact, Facebook has just announced in June that they will offer multiple stable coins based on fiat. So they will have, for example, Libra euro, Libra pound, Libra dollar, and Libra itself, which will operate as a cryptocurrency across the globe. But in particular countries, they will operate some form of Libra fiat coin. So there'll be a specific coin, for example, called Libra euro, and so on. But as well as that, they are planning to collaborate and operate central bank digital currencies. And I'll talk about that in a minute. So central bank digital currencies are digital currencies issued by the central bank. Now, the other aspects of Libra is that they have a whole bunch of partners, and I mentioned hosted wallets before, provided by what they call value-added service providers, like financial institutions today. They'll operate in multiple countries, and as well as that, they'll pull through a whole bunch of products, services, financial services, loans, all kinds of things into a marketplace accessible to this enormous global audience. Initially, by the way, my belief is Facebook will be targeting cross-border transfers and try to tap into the market for the unbanked, provide people who already have a WhatsApp account very popular in developing countries, offer them a digital wallet. So Facebook hits the ground running pretty damn quickly with an enormous potential for customer base. So what I mean by central bank digital currencies. So I showed you that chart before where I indicated the use of central banks and banks to settle money. In other words, an intermediary model. Well, central bank digital currencies mean the currency is accessible directly with the central bank, provided you have an account with the central bank. So you may have an account that allows you to transfer money directly across others because the central bank facilitates that. And there are a number of different models being explored right now in terms of how this would be implemented. For example, some countries are looking at a hybrid model where banks would issue the account, but the settlement and the platform to manage the transactions would be done by the central bank. Others are looking at whether central banks do it directly. Now, central bank digital currencies aren't a proposal. They are being evaluated today. There are a couple of central bank digital currencies already in operation. There's one in China that's been launched recently called a DCEP, for example. Sweden is very close to launching one. The Marshall Islands, very small Marshall Islands, they have a central bank digital currency being implemented as we speak. So this is a reality. Now, some say, like myself, that this is the empire striking back. What's motivated central bank digital currencies? It's been proposed by central banks as a way to provide more functionality that's being competed from by cryptocurrencies. So, for example, you could implement smart contracts theoretically using central bank digital currencies. The question about who hosts it and who manages it and so on. But technically, with digital currencies under central bank, you can have much more functionality. Now, a couple of things need to be considered here. Central banks digital currencies mean much more better and tighter control of money than exists today. Now think about what's happened with COVID. We've all moved to more electronic transactions and gone away from cash. Central banks with digital currencies have the ability to track every single unit of currency down to a wallet and user. So it gives them much greater visibility of their money, and therefore for tax purposes or whatever, for state purposes to control it. It provides them with some benefits. Probably a strong argument for cryptocurrencies, one might say. So let's have a look at how cryptocurrencies have evolved in recent times. Now, this graph here is a graph I used a couple of months ago, and I've updated it. It's an index of prices of Bitcoin compared to the S&P 500. The S&P 500 is an index of the top 500 stocks on the New York Stock Exchange. And you can see that until the COVID crisis occurred, which is around here, which is in early part of this year, cryptocurrencies pretty much wandered around with no relationship to existing assets like the stock market. And in fact, once the crisis happened, and this is true of a lot of assets, they all move together. Everyone gets terrified and is cautious about any investment. And you see a coupling, if you like, a tightening of the relationship between cryptocurrency and traditional assets. Now, we're probably seeing some separation of this, but they're still moving together in a broad direction. There's more gains on cryptocurrency than the stock market, but it's fair to say that they're moving together. Now, has this become more mainstream? Let's have a look at Google. I analyze Google Trends data. This graph here is showing you the interest in searches around Bitcoin compared to the searches for the stock market for stocks. And of course, bonds. Bonds are not very well or commonly used by the general public, but you will see that in fact, there's been a much closer alignment in recent times of searches, and this is, by the way, the COVID situation occurring about here. You see a tightening. So stocks and Bitcoin are searched almost similarly to Bitcoin. So there's a broader acceptance, or perhaps consideration of Bitcoin as an alternative way of either transacting or using it as a way of storing wealth of some sort. So what we're seeing in terms of cryptocurrency, in terms of transition, is that they're taking more institutional approaches. And I talked about, and I'll show you this in a second, more institutional approaches, closer regulatory interaction. They've realized that the regulators will put them in jail in some cases or slow them down, as they have shut down, for example, the ICO market, the initial coin offering market, similar to IPOs in the stock market. That's been shut down by regulators pretty much. They've got expanded financial offerings. It's possible to get derivatives today on cryptocurrency. They've integrated financial market mechanisms. For example, you can buy cryptocurrency and trade cryptocurrency on eToro, a very popular global trading platform started in Israel. All sorts of scalable platforms for cryptocurrency. We see the emergence of things such as IOTA and others, which are designed to work with the Internet of Things, millions of transactions per second. And of course, increasingly, they're simple to use using applications on your mobile phone. And the interesting fact here is the bottom one, which is the emergence of what they call DeFi or DeFi, depending on how you pronounce it, decentralized finance. In other words, financial transactions and instruments that are delivered in a decentralized manner without intermediaries, but delivered on a platform. Now, one could argue whether if something is on a platform, someone operates a platform, whether it's absolutely decentralized. But what this is simply saying that the role of intermediaries is eliminated to a certain extent, and the platform facilitates transactions rather than having someone in between collecting a tax or a return or an interest on your transaction. So how is the trust issue being achieved? One of the big issues that, and Kim and I have done another paper on whether crypto can be trusted and what it takes to trust money. We looked at what is the difference between fiat and cryptocurrency. And when we looked at the organizational infrastructure or the institutional infrastructure that exists to support fiat, dollars, regular money, there's a model we got inspired by the tech sector, the OSI 7A model. We use that to articulate what we see in terms of institutional support for fiat. And you see there's quite a bit there. There's consumers, of course, who use it. There's the business and government services, payment transfer systems, a central bank with gross settlement, and so on. I won't go through all of this, But the point is there's quite a substantial infrastructure, government and courts, international institutions that support fiat. In the case of cryptocurrency, on the other side, we see that there's very little. There's just a platform, some businesses and consumers using it. And that's the extent of the support you can expect in cryptocurrencies traditionally. Well, at least I shouldn't say traditionally, in recent times. Libra has taken a different approach, and they're approaching the market recognizing there's a need for some sort of intermediaries using what's called exchanges or decentralized applications and so on, together with exchanges, hosted wallets, I mentioned that before, and recognizing the need for regulation and working with regulators. So Libra, interestingly enough, has located themselves in Switzerland and is working with the Swiss regulator to provide and make sure that they meet certain criteria. They've also worked with other governments in the United States and so on to try to appease, if you like, the central banks there about them trying to subvert control of their currency by issuing their own money. So they're issuing stable coins based on US dollar, euro, and so on. So let's have a look now at COVID-19 and the wider economy. And I'll try and pick up the pace a little bit, but I've got another poll here now to share with you. So let's do another poll. This next poll is the third one here. Let's see. So in your opinion, how long do you think COVID-19 will take to pass, if you like, and us to return to normal? So what do you think? This is an interesting one because when you're sitting where I am in Victoria, in Melbourne, it's pretty hard to see when the end of this thing will happen, but certainly there's a range of views about this. My personal view is that it's probably going to take 3 to 5 years for the economy to return to something like normal that we would recognize. But that's just my opinion. So I'll take this poll off now and end it, and the results, you can have a look briefly, and I will turn off the results shortly. But as you can see, most of you think it'll take more than 3 years, which is my view. And we'll talk more about that later in economic terms and its relationship to cryptocurrency. So let's move on. So let's have a look at the debt picture for different countries. Now, I put this chart up specifically for one reason, and that is one of the principal motivations for cryptocurrency has been that governments can't be trusted to manage money and debt, and they create so much indebtedness that eventually they print more money, more and more money, so they devalue the currency. So let's have a look at this. This is as of December 2019. So you can see that Australia relatively good on the public debt side, 44% of GDP, compared to the US, which is 107% of GDP and growing dramatically. And if you compare that, which is more concerning for me in Australia's case, is household debt. We are probably one of the most indebted countries on a household basis relative to our income. So 217% of our income is in household debt, one of the highest in the world. And by the way, this is principally driven by house prices. So the point I'm trying to make here is that we start in a very precarious position in terms of global debt before COVID hit us. In the US's case, tax cuts and so on. And the reason I harp on about the US is that the US enjoys a unique position in our global economy. It is the reserve currency. Every currency in the world is based on to some extent and related to the US dollar. So every currency can only translate from one to another using the US dollar. I can't go unless I make a private agreement. I typically, if I use banks, they will transact and convert based on the exchange rate based on the US dollar as the reserve currency. So we start in a fairly precarious situation. And what happens? COVID hits us. Now, this is a graph I got from AMP, which shows economic activity, and it takes into account credit card data, all kinds of things, job seeker ads. So it's a composite index of the economy prior to and after or during COVID. And you'll see there that typically economic activity is around 20% lower right now, and in the case of Victoria, even lower, but sitting around 20% to 20 to 25% below a normal level. Now, what does that mean? GDP measures the level of activity in the economy, how much we produce on an annual basis, produce and consume on an annual basis. And right now, this is suggesting that our economy is going to shrink by about 20%, maybe, depending on how much money the government puts into the economy to stimulate spending. But certainly our activity has dropped. And if you look at the year-on-year forecast GDP changes, and this graph, I won't go through it, but in detail, just to highlight a couple of important points. In the case of Australia, this is suggesting that our GDP has fallen by around 7% so far, as of June. This is a forecast based on consensus done by the IMF and the Bank of International Settlements. You'll see in the case of Great Britain, it's close to 15% on the outside. This will shift further down in Australia's case as the virus second wave, if you like, continues. In fact, it's been estimated that the second wave, if you like, that's occurring in Victoria will cost the Australian gross GDP about $5 billion so far, just if you put a number on it. Now, why am I telling you all this? This means that governments will have to stimulate the economy much more, incur more debt, print more money to get us through this crisis, which runs the risk of causing some other consequences as we move out. And this is a graph also from the BIS showing you how much of our GDP, how much of our economy we've used in terms of our budgets to stimulate the economy so far. And it's around 10% for Australia, 8 to 10% for Australia, excuse me. As well as that, there's a whole bunch of non-budgetary measures, and I won't go into this. This is just talking about things such as guarantees and so on provided to other institutions, other companies, etc., that are not spent yet, but they provided guarantees which will end up being part of the debt, more than likely, if those guarantees are used. So a lot of pressure on national budgets. But let's look at the dependency on the US dollar globally. And this graph here is showing you what percent of the total reserves of the world are held in US dollars. And you can see that since the year 2000 has gradually risen so that something like 72% of all reserves, money held by central banks and so on, held in US dollars, is in fact dominating all reserves. So we're very dependent on the US dollar, and provided they manage it properly, then maybe we will get through this. But the cryptocurrency folks don't believe that's the case. They say the US dollar is a problem. And in fact, I've used the term exorbitant privilege. This was a term introduced by the French president in 1960, I believe in 1965. Until 1971, the US dollar was gold backed. In other words, if you held reserves of US dollars, you could take it to the Federal Reserve, the United States Federal Reserve, hand those dollars across, and they would have, because that's a liability, they would hand back to you gold. Well, the French felt that the US was abusing its position to issue more debt, if you like, borrow more money at a privileged rate, and use that to fund their economy when other countries weren't able to do the same. And in fact, they sent a warship over to the United States to pick up the gold and bring it back to France. And in 1971, the US went away from the gold standard because it was unable to maintain the reserves for the money it was creating. Now, that's an interesting point because people sometimes say, well, Bitcoin is created on nothing. Well, guess what? The dollar isn't created on much more than that either, but the difference is it has institutions backing it, institutions supporting it. Now, what's happened before when there's been a crisis? Typically, governments have regulated gold. And I won't go through all of these, but almost every government has somehow constrained the use of gold. In other words, if you felt your money was going to be worthless and you tried to convert it to gold, you were restricted there. They wanted you to use the currency. They wanted to enforce you to use the currency. Another argument that cryptocurrency folks say for taking up cryptocurrency is that governments can't control it. So let's have a look at the post-COVID economy now, very briefly, and I'll launch another poll here that takes your opinion about what things are going to look like and how you can protect your wealth. Let's have a look. So here's the setting. Post-COVID world, lots of debt, lots of money. How do I protect my position with my wealth? So if there's lots of money post-COVID, a risk of inflation, risk of devaluation of fiat money, Australian dollar, US dollar, whatever, how will I protect it? This is the question I'm asking you. How would you choose to protect your wealth? So if you have money today, how would you protect it? Now, this is not financial advice, but in my opinion, I'm looking at, for example, how to move into real assets, to move into stocks, for example, because stocks have the ability to pass through inflation. Companies do business and they pass on the prices to consumers and therefore earn more value and increase their share price and so on. So a number of strategies possible. The worst possible place is probably to have money sitting in a bank account if you expect inflation. So I'm going to now talk about the post-COVID world and then try to move this forward. I'm nearly out of time. Here we go. So I'll end the poll now and I'll continue. So let's have a look. What does recovery look like? Now, there's 4 graphs here on the bottom side. And the first point is, well, it depends on virus control and consumer confidence. Oddly enough, the biggest single factor probably that's likely to drive recovery is consumer confidence. Industrial activity and employment obviously will help this. In other words, the more activity we have, jobs, people in jobs. How governments manage all the money that they've borrowed and put into the economy. Where does it end up? Do we end up issuing more debt and end up with more money being printed and so on? A big one, geopolitical stability. We're seeing lots of emergence of dispute around how the monetary system will be managed, and I'll talk about that in a minute. So what will the recovery look like? Will it be a U? In other words, we've had this drop, and then gradually we'll recover. It'll take us a long time. There's some who think it could be a V. In other words, we've had this drop, but we'll recover fairly, reasonably. Others think we'll have a drop, we'll recover, but there'll be some fall off because the economy doesn't react well to, in a sustainable way, to the government injection of money. So we put some money in, we get things up a bit, but it doesn't sustain, it drops again, and the government runs out of stimulus, if you like, and maybe then it takes some more time. Or is it an L-shaped recovery, meaning it drops, it takes a long, long time to recover, and we lose a chunk of the economy. So in that sense, it's up to you to decide which version. My personal view is it's probably likely to be a U-shaped recovery, although there's no specific data to formulate this at the moment. So let's look at post-COVID settings. What does the world look like? We're going to see much more cautious and conservative consumers until we see a vaccine, maybe until we see perhaps some cures. But in the meantime, people are saving more money. There's lots of evidence that people are, in fact, saving more and getting out of all sorts of investments. We're seeing that digital payments are fairly common. Everyone's very comfortable now paying digitally. And I say everyone, I'm generalizing here, but it's, because of a reluctance to exchange cash and so on, digital payments have taken off dramatically. Unemployment and fiscal pressure. Unemployment is likely to take 5 years, by estimates from previous experience, to return back to, in Australia's case, around 5%. They're expecting the unemployment number to be well above 10% once it settles. The Treasurer was reporting the other day that the unemployment numbers reported around 8%, I think it was, or well understated. An enormous debt burden. So I showed you before this huge debt that's sitting on government's balance sheets. How do they get rid of that debt? Well, they've got to maintain interest rates to keep them low so the economy doesn't get killed. So they end up printing more money to buy back their own debt. So that's debt monetization. And all this leads to inflation, potentially, down the track. Now, economists are actually split between whether there will be deflation, you're going to say, wow, deflation, or inflation. And in fact, If the supply side goes ahead faster than the demand side, people buying stuff, then you may end up with a deflation scenario. But if you get demand picking up faster than supply, then you could get an inflation scenario. No one actually knows, but there's strong views that potentially we'll end up in an inflation scenario, even if we do go through a deflation initially. And finally, currency and capital control. The governments have now got this enormous debt. They'll be wanting to make sure that money doesn't escape the system, that money doesn't flow into other markets, that the domestic economy is protected. So there will be all sorts of monitoring and constraints on capital and currency flow. And evidence from countries where there has been problems with inflation and so on, and I can think of places like Turkey as an example, where they were forced, not by formal decree, but by the government saying you must convert your foreign currency holdings into Turkish currency. So I'll skip through the slide in the interest of time, but governments have demonstrated time and time again that they're willing to control their currency for the sake of protecting it. This has happened in a number of countries. So what are potential cryptocurrency roles going forward? Potentially, cryptocurrency could obviously play a bigger role in money transfers and e-commerce. Increasingly, we're seeing platforms to provide that. We see websites accepting Bitcoin, and so on. So this is growing dramatically at the moment because of people's getting more comfortable with it, and because of the, if you like, growth of digital payments, becoming a basic bank account, a way of storing my money. And think about it now, it's out of the fiat system. It means it's probably less fluctuation maybe than there is of my Aussie dollar. An alternative investment, as a speculative investment, maybe I start to invest in some cryptocurrency for the sake of, and relative to fiat, which is probably depreciating, it may serve that purpose. A borderless payment platform. It's already been successful in this area. It can, in fact, be used to transfer money across borders and avoid taxes and so on. We talk about assets, stock markets, different kinds of investments being denominated in fiat. Why not denominate them in cryptocurrency, where you don't have the fluctuations or the risk of inflation? And finally, potentially, it could become a quasi-reserve. If it's used across the board globally, then potentially it could be used as a quasi-reserve currency. And finally, of course, as central banks see it, it's a threat to their sovereignty and control of money. So finally, coming down the line, by way of a brief summary, what's coming down the line? Well, a vaccine for COVID-19, more viruses, maybe, the new normal, the acceleration of digital payments platforms. This is going to become more and more commonplace, and these platforms will and are taking cryptocurrency as a form of payment. And really, the extent to which cryptocurrencies become comfortable for us will depend on how many people use it. How many people use it is a function of trust. And think about Facebook and Libra. Everyone's got access to Facebook. They do some kind of transaction there. They're buying stuff already on Facebook and so on. Why not put some money into that system? Why not experiment with it? And gradually you'll see people getting more used to these platforms. There's a big tech cold war on, by the way, at the moment. For example, and I talk about tech cold war, Huawei being shut down, access to chips being restricted by the United States to China and other countries, decoupling of the supply chain, manufacturing, COVID exposed the risk in global supply chains where products can't be completed or accessed because of the risk of closure or access to particular markets. We're already talking about producing vaccines within each country because maybe we won't have access to them. So fortunately, in Australia, we have a leading University of Queensland, who has a strong virus prospect. So we're seeing all kinds of if you like, storm fronts in this area, but certainly a tech cold war. Banning one of these social media applications, that's coming. We've already seen a whole bunch of technical companies facing all sorts of problems due to the tech cold war. Now that feeds into cryptocurrency because it can avoid all this stuff. You can transact without worrying about all these things. Moving on, central bank digital currencies. These are a reality. These will start to happen, although it may take some time, depending on how the market reacts and accepts cryptocurrencies, perhaps.
John, I'm sorry to interrupt. We're going to have to pause for a couple of questions just to slip them in before.
All right, so I'm stopping now.
Yeah. So just a couple of quick questions. First one that came up was, what does crypto look like as a percentage of total currencies? And I imagine to answer that question, you'd have to know something about what they're worth in markets at the moment. So could you?
So cryptocurrencies are around $300 billion. Okay. The total market for fiat is several $100 trillion. So it's very small.
Okay. It's tiny, but still that's a big number in absolute,
correct.
in absolute figures. There's a some follow-on questions as well. What trigger, and we've seen a trigger with Zoom, we've seen a trigger with this online change of work with COVID. What will be the trigger? I mean, you've hinted at it a bit, but what will be the trigger for people to really swing big time into crypto?
Capital and currency controls.
Capital and currency controls. Okay, great. Very simple answer. What sectors do we think are probably likely to accelerate first in crypto?
I think, as I mentioned before, we're talking about trading platforms. So we'll see that things around e-commerce will probably take up faster because people will be looking to buy and sell things more easily, and it's quite easy to adopt crypto into that framework and get people used to it. So ubiquity is important. Getting used to using a form of money is really important. And an easy place to start is to buy and sell stuff, right? And then we move. Sorry, the other one I was going to say was foreign exchange transfers, moving money across borders.
And obviously, this is very contingent on the institutional environment. So which countries do you think that's likely to appear in first?
I think you'll find that in the case of exchange transfers, foreign exchange transfers, it will be the developing world, because there's a lot of transfers that happen back to places like Philippines and so on, and it costs a lot of money to do those transfers. And one of the things possible with cryptocurrency is atomic settlement or more rapid settlement. So instead of taking days and a lot of money to transfer from one bank in the US or wherever you're working back to your home country, then you can use cryptocurrency to do it, A, much faster, B, probably more cheaper, and C, probably, if you want to, without disclosure.
So that's a really nice way of answering it, because you're basically what you're saying is where transaction costs are high, people will look for the cheapest way to trade. And I think a great example of that has been China, where it was phenomenally difficult. Indonesia was another one, very difficult to move money around the country. And then it wasn't crypto, but it was a digital currency that has emerged, an online trading environment. Can you talk to us a little bit about crypto and its interaction with the Renminbi, and where you can see, are they going to co-travel together? Will it lead to an opening up of China's financial system? No,
I think that China wants to control its currency very tightly. It's putting in place a lot of measures because they've had lots of, shall we say, entrepreneurial activity with their currency, and they're trying to factor around it in. China just announced, for example, that they will apply their tax regime globally. So wherever you are, you'll pay tax at 45% or whatever it is. And this is being protested, for example, in Hong Kong. This is a result of the Hong Kong thing. Now, so I don't believe Renminbi will be relaxed, if you like. They'll be looking to increase currency control. And in fact, the principal reason they're introducing central bank digital currencies to say, look, hey, you don't need to go to these other ways of payment, other forms of currency. You can use central bank digital currency to achieve the efficiencies you want to achieve, etc. And by the way, it gives them a better measure of control. So they're doing that in a hybrid model with their banks. So their banks will be the issuing the wallets, if you like, together with the central bank, who will facilitate the transfers. Now, it's very early days yet, but there's lots of, in my opinion, lots of evidence around the place that central bank digital currency is going to be a way of trying to constrain, if you like, any explosion of alternative or grey money initiatives like cryptocurrencies.
And we've seen that a lot in digital spaces, the proverbial walled garden. We will structure the institutional environment, and that lends institutional strength. But here's a follow-up question. It was a very legal one that came in, and I'll just make sure that I got it right. The question was, how is the case law around crypto evolving? I know you're not a lawyer, so John, I'm not going to totally put you on the spot, but What sorts of issues do you see emerging? Because obviously there's a whole legal code that needs to be written around this if we are going to do what you've just suggested.
Yes, there's a lot of work being done in this area around payments. What constitutes payment? The lawyers are very concerned about, the legalese around, if you like, cryptocurrency and digital payments, because when a central bank structure, it's very clear that who's responsible and when settlement occurs, and I won't go into a lot of detail on that, but suffice to say, it's being tested right now, and a lot of research is being done in this area. Can cryptocurrency, in fact, do they represent final settlement in legal sense? And by the way, who the hell do you go to if that doesn't happen? Because it's operating in the ether. So there's all sorts of issues around protection of property rights, enforcement of contract, and so on. But suffice to say, this is new, and some of the case law is being written as we speak.
So John, just one last question, because we are going to have to wrap up. All of this change as it makes its way through, and we've said, next 5 years, we've talked a lot about inter-organizational change. We've talked about institutional change, central banks, and so on. But how is this, because these transaction costs are going to change, how are these transaction costs going to alter the rules of the game for organizations? What sorts of organizational structures are we going to see? I mean, the standard sort of multinational corporate that we both worked in, that we both had experiences with, how is that going to change in a crypto world?
Well, one of the things that's come out of the crypto world is the concept of the DAO, D-A-O, decentralized autonomous organizations. Now, what that means is that instead of having a hierarchy and a centralized authority, that you can operate in a decentralized manner. That means decisions and transactions occur automatically through a set of contracts. Now, you and I, as being very interested in this area, we think of companies as a collection of contracts, to quote Ronald Coase. So if you think of a company as a collection of contracts, in other words, it buys wholesale and sells retail, if you like, then the ability to automate that in a decentralized way means you actually have to rethink how companies are structured going forward. Now, this is one of the, if you like, innovations that cryptocurrency brings, this whole idea of decentralization. Well, what's a company under a decentralized world? If anyone, I go to a company because I want to acquire something and the company knows stuff about a particular product. What if I could get it on a platform, connect the buyer and seller without having to pass through a middleman? So we talk about banks as being middlemen. There's plenty of middlemen in the e-commerce world, right? You accumulate product, you warehouse it and sell it, right? And you add margin to it. What if you could go directly to the supplier? You disintermediate companies, basically. Instead of disintermediating banks, why not disintermediate companies? And this is some of the innovations that cryptocurrencies can bring into the larger corporate world. Disintermediation, not just of banks, but also of any kind of middleman. If you think about Uber, Uber disintermediated taxi companies, right? It connects basically the driver and the passenger on a platform globally, right? In different places. All the
So basically, changing the transaction costs can potentially drive disintermediation, can drive the evolution of new business models. It's so interesting to hear all of this, John. When I think back over the journey that we've all been on, our listeners included, over the last 6 months, here we are today holding a masterclass, all of us spread across Melbourne and around the globe. There are big changes afoot, and I'd just like to thank you for giving us this angle from a cryptocurrency perspective. And I hope that we'll have more lectures like this in the series to get people thinking about what's coming down the pipeline. John, once again, thank you very much. And thank you very much to our listeners for logging in today. And we hope to see you at another masterclass before long. Thank you.
Thank you, everyone, for attending. Thank you.